Hi, Adam Spears here with Cross Country Mortgage again. I wanted to review today the difference between doing a cash-out refinance versus opening a home equity line of credit, and what circumstances are appropriate for either, and what kind of versus a home equity line of credit versus what a cash-out refinance is. So first, let's talk about home equity line of credit. So this is exactly what it sounds like. It's going to be a line of credit that's based on the value or equity that you already have in your home. And when are these things, or when are home equity lines going to be more appropriate than, say, a cash-out refinance? So, for instance, if you had a project that you wanted to slow draw on, or you just wanted to open a line of credit and didn't necessarily have a project in mind, but you did want to have access to the money in case something came up. Home equity lines of credit are great for that. They're also good because if maybe you don't have as much equity in your home, you can still take out, and in some cases with some lenders, a line of credit that'll let you go up to, say, a 90% loan to value or 95% loan to value. And I think there's probably a few out there that'll let you go even higher. The other good thing about home equity lines of credit are that you're paying interest only on the majority of them. Majority of how they're set up is that they're going to be interest only payments for up to 10 years, I believe. That's kind of how the majority of them are set up. And so therefore it's going to be a smaller monthly payment for you and a smaller monthly obligation. But after the 10 years is up, then you do start hitting with the principal and your payment will go up. So now let's talk about the other side. Let's talk about a cash-out refinance and why this might make more sense. So a lot of times we're doing cash-out refinances to combine the debt that you have already incurred from, say, a home equity line of credit. Let's say you've maxed out your home equity line of credit, you've drawn the entire balance, and now you want to, you've only made interest-only payments on it for, say, 5-6 years. Now you have the equity in the home that you could roll that together. When we combine those two loans, that's going to be a cash-out refinance. And we can also, say, give you additional cash, assuming that you have enough equity in your house. Now, the other part of a cash-out refinance is you can only go up to an 80% loan to value with a cash-out refinance. So we need to have a little bit more equity in the home in order to do that. But cash-out refinances are going to be great for, say, debt consolidation, or if you already have a project in mind in your home and you know the exact amount that it's going to cost and you want to take that amount of cash out from your equity, cash-out refinances are great that way. And we're still finding that with rates as low as they are, we are able to do cash-out refinances for people, give them money back, and still lower their interest rate from, say, if you took your loan out maybe 2 years ago, 3 years ago. So there's a lot of that happening right now too, because again, home values went up a lot, so there's a lot of cash-out refinances that are being done. So if you have any additional questions about cash-out refinances versus home equity lines of credit and which might be best for you or your particular scenario, feel free to call me or email me here and we can have a longer discussion about it. Until then, see you next week.